with how things are going. What explains that?
Well, I think the thing is that consumers and American voters, they remember what they were paying for things at the grocery store 4 or 5 years ago. It wasn't really that long ago. And so inflation is still very much present in their minds, even though the monthly and annual inflation figures have come down. So price growth has eased. Prices are still higher than then. So I think that plays a big role, even though, as you pointed out, gas prices may have come down. Certainly certain categories have fluctuated and some have improved. Broadly speaking, you're not going to see prices across the whole economy come down. That would be disinflation. That would actually be worrisome. That's not a great sign for a healthy economy. So we're still seeing some prices inch up, and overall, consumers are paying more than they were a few years ago, and they're just still not that happy about it.
And Kate, I'm a person of a certain age. I remember the 70s and 80s. Heavily inflationary times, much larger than they are now, higher interest rates then than now. But a lot of Americans have no memory of that. All they have memory of is low inflation basically for all of their lives. And this spike really took them by surprise.
Sure. I think something else that's been surprising, though, it's worth pointing out, is that what we haven't seen, or we didn't see this time around, was the high unemployment that was required in the 70s and 80s to bring prices down. So that has been very unusual. Economists are still trying to unpack what exactly happened there, why that was. Does it have to do with a broader supply of workers and immigration? That's something that officials, for example, at the Federal Reserve have cited. So I think that, by comparison, again, this economy is doing pretty well. And I think we should consider ourselves pretty lucky that that price pressures have come down in the way they have without a bigger hit to the economy.
And we were just showing on the screen the unemployment rate, jobs created. Those things have been largely on the bullish side of the equation, continuing to create jobs. Wages have gone up, haven't kept pace with inflation throughout the entire Biden-Harris administration, but lately they've caught up and exceeded a little bit. That's providing some relief, but not nearly enough.
Sure, right. Things have gotten a bit better, and that isn't to say, right, that certain groups, have really felt this pain. I think that there are starting to be some concerning signs among lower income groups about rising delinquency rates. But generally speaking, again, the American consumer has really continued to power this growth, and there have been, there's been a lot of prognostication about how much longer can it last. Surely next month we're going to see these numbers come down, and we see retail spending data, we see consumption data. It's just very, very strong, despite these very high interest rates that you mentioned.
And there's a kind of muddled picture of what the future looks like to consumers. So the Conference Board, I want to bring that up, has a consumer confidence index that went down for the month of September. And the University of Michigan has a consumer sentiment index that went up. Mm-hmm. So what's the difference, and how should we gauge where consumers think things are now and what they're imagining they'll be in the not too distant future?
Sure. Well, these measures are always very tricky because they are really tied to politics. They're increasingly partisan. They survey people who run the survey have found that Republicans are typically happier when there's a Republican president in the White House. Democrats have a better outlook when there's a Democrat. I think the most recent numbers from the Michigan survey, for example, showed that a big part of that pickup was because Republicans are more confident that Donald Trump will win the White House, and Democrats a little bit less confident in recent weeks. So I think it is hard to disentangle what it means for the future, and probably those measures are going to shift after Election Day for sure.
Measures are going to shift after.
If you look at what the unemployment rate is, that remained at 4.1. So people are going to scratch their heads. Hey, lousy jobs report. Why 4.1? Because the rate comes from the household survey, and the household survey counts those that are off work, absent due to strikes and storms. So they're counted as employed. It remains at 4.1%. Now, let's look at the average hourly earnings month over month. They remain sticky, up 0.4. I would think that's a good thing. We're expecting a 0.3 number, and in the rearview mirror, the 0.4 was revised to 0.3. Now, if we look at year-over-year perspective, it also remained at 4%. 4% was the original release last month. That was downgraded just like the month-over-month to 3.9. So it's hotter technically, but as expected in prior to revision, it was equal to last month. Now, if we look at the work week, 34.3. It built a little bit more in. It went from 34.2 to 34.3. And last month, a revision, late revision. So it moves up from 0.2 to 0.3, it equals that. Why is that so important? Sometimes less hours worked has a tendency to kind of artificially boost wages. And finally, let's look at the labor force participation rate. 62.7 expected, 62.7 in the rearview mirror, but it comes in participation light, 62.6, which equals where we were in June. To find a lighter number, you have to go to the month before that, to May. And finally, the underemployment rate. 4.1 is called U3. That's the normal employment rate we use in all data. The underemployment rate, known as U6, comes in at 7.7, where it was last month. To find a higher number, you'd have to go to August when it was 7.9. So we have made some progress there. The market's very volatile. We've seen a trade close to 432. We've seen a trade down around 423. Those are, of course, in 10-year yields. It's currently trading at 425 and change. Do keep in mind that it closed last week at 424, so it's still up in yield on the week. And at 411, we see that the 2-year note has given back quite a bit of ground here. It was at 420 prior to the number. So an outsized effect was expected with the weak number, whichever come. If you look at what the unemployment rate is, that remained at 4.1. So people are going to scratch their heads. Hey, lousy jobs report. Why 4.1? Because the rate comes from the household survey, and the household survey counts those that are off work, absent due to strikes and storms. So they're counted as employed. It remains at 4.1%. Now, let's look at the average hourly earnings month over month. They remain sticky, up 0.4. I would think that's a good thing. We're expecting a 0.3 number, and in the rearview mirror, the 0.4 was revised to 0.3. Now, if we look at year-over-year perspective, it also remained at 4%. 4% was the original release last month. That was downgraded just like the month-over-month to 3.9. So it's hotter technically, but as expected and prior to revision, it was equal to last month. Now, if we look at the work week, 34.3, it built a little bit more in. It went from 34.2 to 34.3, and last month, a revision, late revision. So it moves up from 0.2 to 0.3. It equals that. Why is that so important? Sometimes less hours worked has a tendency to kind of artificially boost wages. And finally, let's look at the labor force participation rate. 62.7 expected, 62.7 in the rearview mirror, but it comes in participation light, 62.6, which equals where we were in June. To find a lighter number, you have to go to the month before that, to May. And finally, the underemployment rate. 4.1 is called U3. That's the normal employment rate we use in all data. The underemployment rate, known as U6, comes in at 7.7, where it was last month. To find a higher number, you'd have to go to August when it was 7.9. So we have made some progress there. The market's very volatile. We've seen a trade close to 432. We've seen a trade down around 423. Those are, of course, in 10-year yields. It's currently trading at 425 and change. Do keep in mind that it closed last week at 424, so it's still up in yield on the week. And at 411, we see that the 2-year note has given back quite a bit of ground here. It was at 420 prior to the number. So an outsized effect was expected with the weak number, whichever come. If you look at what the unemployment rate is, that remained at 4.1. So people are going to scratch their heads. Hey, lousy jobs report. Why 4.1? Because the rate comes from the household survey, and the household survey counts those that are off work, absent due to strikes and storms. So they're counted as employed. It remains at 4.1%. Now, let's look at the average hourly earnings month over month. They remain sticky, up 0.4. I would think that's a good thing. We're expecting a 0.3 number, and in the rearview mirror, the 0.4 was revised to 0.3. Now, if we look at year-over-year perspective, it also remained at 4%. 4% was the original release last month. That was downgraded just like the month-over-month to 3.9. So it's hotter technically, but as expected and prior to revision, it was equal to last month. Now, if you look at the work week, 34.3, it built a little bit more in. It went from 34.2 to 34.3, and last month, a revision, late revision. So it moves up from 0.2 to 0.3. It equals that. Why is that so important? Sometimes less hours worked has a tendency to kind of artificially boost wages. And finally, let's look at the labor force participation rate. 62.7 expected, 62.7 in the rearview mirror, but it comes in participation light, 62.6, which equals where we were in June. To find a lighter number, you have to go to the month before that, to May. And finally, the underemployment rate. 4.1 is called U3. That's the normal employment rate. We
have Joe Brusuelis. He's RSM's chief economist, and we're also joined by Kathy Jones, Charles Schwab, chief fixed income strategist. Great to have both of you here. Joe, let me start with you. Just the magnitude of this miss, if you want to call it that, 12,000 jobs added to the economy last month. What's your first reaction?
All right, so this is a jobs report you want to take seriously, but not literally. The noise all over this report, it won't just be October, it's going to be November also. You can see the Boeing numbers inside the manufacturing complex, but also as I'm looking here, I'm seeing a pretty big downturn in professional business services, which is where you would expect individuals who work in retail, also in leisure and hospitality, which went down by 4,000. Those are going to be displaced workers because of Hurricane Helene. Now, the way we looked at this prior to the report was that we thought you'd get a movement in two parts. One would be October that would capture both the Boeing strike and Hurricane Helene. And then in November, we think that the Boeing strike will also be part of that, but you get Hurricane Milton. So essentially, guys, we're not going to get a clean look at the labor market until January of next year in the December report. Now, the 4.1% unemployment rate and the 4% increase in wages, that's a much better indication of the true underlying fundamental strength of the American labor market. Ignore that top line, look at that 4.1% and just get on with it.
Kathy, want to get your reaction to this report?
Yeah, I would agree with Joe that the non-farm payroll print was actually within the realm of what we would call the error range around what we were expecting. So if 100,000 was what was expected by the street, getting something even as low as minus 50 would have been within the range of possibility without it signaling a change in the labor market because of these temporary factors. So I'm encouraged by the household survey. I'm encouraged by the fact that average hourly earnings are hanging in there right around 4%. I would agree, kind of push this one to the side. Look at November and see what we can figure out from November, which may not be much, and then just keep moving.
Joe, do you think the markets are going to continue just taking this number in stride, just given that noisiness?
Yeah, this is all noise. It's just distortions. Market will move on, so will the Fed. We'll get that 25 basis point cut November 7th, but hey guys, the U.S. economy is in such a strong position now. The Fed may choose to pause in December because they need to take a moment and ascertain if the growth path is meaningfully shifted up from the long-term trend growth rate of 1.8% that's embedded in their forecast to something closer to between 2.5 and 3. Now, if that's the case, we'll see that, at least migration towards that, in their December SEP. That's a much bigger deal than any of this.
Kathy, are you anticipating that we'll still get the cut at the November meeting here? As we're taking a look at the CME FedWatch tool, it looks like there's still a 91% chance, or probability rather, for a cut that many out there are trying to perhaps bake into their own kind of estimates around how the markets should react to that.
I do expect the cut in November. There's a case for a pause, simply because we had those upward revisions to the September numbers, and as Joe pointed out, the economy has been growing at roughly 3% pace, which is well above what the Fed, sort of thought was the run rate here. But I think we would have gotten some signal from the Fed if they were inclined to pause on the November meeting. A December pause, much more likely, and after that, the market's already anticipating a much shallower path of rate cuts going forward by the Fed. And I think that that will be reflected in the next dot plot and the next SEP as the Fed comes around to this view that perhaps, the economy, due to productivity growth, due to underlying health in the labor market, the economy is really growing closer to 3%.
Hi, everyone. Thanks so much for joining today's press conference on the release of the European Economic Outlook. My name is Camila Perez. I'm a communications officer here at the IMF, and we're here with Alfred Kammer, director at the European Department. We're also here with two of his deputies, Oya Selasun and Helge Berger. We're going to get started with some opening remarks from Mr. Kammer, and then we're going to go to the floor and online to take your questions. Alfred?
Welcome to this press conference on the economic outlook for Europe. Headline inflation has come within reach in targets in advanced European economies, but progress remains uneven in Central, Eastern and Southeastern European countries, CESI as we call it. A moderate recovery is underway. This reflects that financial conditions are still tight as the easing cycle will take time to take effect. Importantly, the rebound also reflects a high level of uncertainty that keeps consumers and investors cautious. Our main message today is that Europe's recovery is falling short of its full potential. And more importantly, the medium-term outlook is no better. Europe has fallen behind. And I will come to this theme back later, but let's briefly look at our near-term outlook first. Our baseline foresees a modest increase in growth for 2024 and 2025. On inflation, we expect the ECB to sustainably reach its target by mid-25. For most CESI countries, it will take a year longer until 2026. So for this to materialize, Europe needs a safe pair of hands. Central banks should pursue a smooth loosening path in advanced economies, and they need to be more careful and ease more cautiously in several CESI countries, as real wages may outpace productivity growth there. We also recommend tightening the fiscal stance across most of Europe. We are expecting a recovery, but deficits are too large to stabilize public debt. The good news is that the EU has agreed on a fiscal rules framework addressing sustainability concerns while allowing for investment in green transitions and infrastructure. Now we need to follow through. But the urgency for policy action is even more acute when it comes to the medium term, and that's really what our report is focusing on. Europe has an underwhelming potential growth rate, and when we are looking at the medium term, that is not changing. Compared to the US, income per capita is a stunning 30% lower, and the gap has remained unchanged for 2 decades. And I should say at the turn of the century, that gap did not exist. Low productivity and CESI, a low capital stock are the main, low productivity and in CESI, a low capital stock are the main reasons. Our report identifies 3 factors holding Europe back. First, Europe markets are too fragmented to provide the needed scale for firms to grow. Second, Europe has no shortage of savings, but its capital markets fail to provide to boost young and productive firms. In addition, Europe is missing skilled labor where it is needed. A deeper, more integrated single market can resolve most of these issues. This means removing the barriers that still prevent goods, services, capital and labor to flow freely between countries. We estimate existing barriers in Europe's single market to be equivalent to an ad valorem tariff of 44% for manufacturing. Between US states it is 15%. And that tariff equivalent is 110% for services between EU countries. These are staggering numbers that illustrate how much income Europe leaves on the table. While private investment is key, there's also a need for public investment, for example on infrastructure, connectivity, and in addition, deepening and broadening the single market could support a faster growing and more resilient Europe. New member states joining the EU in 2004 saw that GDP per capita increased by more than 30% in the 15 years after EU accession, helped by strong reforms and market access. And the larger single market also helped old member countries. So Europe can close the gap with the global frontier if it builds on its most important asset. And I have been emphasizing that in the past, and I continue to emphasize that, and that is the EU's single market. So what are some of the immediate steps which we are outlining? Open energy, telecommunications and financial services sectors. This will bring more private sector investment, dynamism and innovation. Advance the capital markets union. This will funnel savings to the most productive firms and startups. Make a real effort to ease administrative barriers to firms entering markets, especially in the service sector, and improve infrastructure, institutions and governance in CESE countries. So in conclusion, Europe has the means to lift growth to its full potential. This is completely under Europe's control, and it needs to be done. Thank you.
Thanks so much, Alfred. We're going to get started with some questions in the room. I see there are some colleagues online. We will get to you, but we're going to take the first question. The gentleman in the second row. Thank you.
Thank you so much. Yaroslav Dolgopol, Ukrinform News Agency, Ukraine. In the recent World Economic Outlook, the IMF predicted a slightly better growth for Europe in this year and worse dynamics in 2025, especially for emerging and developing economies. You already described some factors which are driving this process, but I have a question regarding the particular issue. This is Russia's war in Ukraine. How does this factor affect the dynamics in Europe now? And secondly, the IMF significantly marked down the projection for Ukraine, at the same time saying Ukraine's economy remains resilient despite the war. Could you elaborate, please, on the exact reasons for these negative expectations? What could be done more to improve the situation in Ukraine? Thank you.
So let me start first with the general impact of Russia's war in Ukraine on the European outlook. When you're seeing the growth trajectory, it hasn't changed very much over the last year. And the main reason why Europe is doing poorly is really the large Russian induced energy price shock Europe is going through. So we are seeing this year coming out of this crisis a moderate recovery. It's driven mostly by consumption as real wages are strengthening. And we are expecting then next year that we have a handoff to investment demand when policy rates, interest rates are going to come down. So very much when you're looking at some of the more detailed picture, Germany very much affected because of the energy price shock still, because of its energy intensive manufacturing. That's a direct impact of the Russian war. If you're looking at the tightening cycle of the ECB, that had to be harsher simply because inflation was higher. That's a result of Russia's war in Ukraine. So that is the general trajectory we are on. But we also have revised down growth for 2025. And what we're seeing is a bit of moderation in the recovery we have been projecting. And again, it's a result of the uncertainty created as part of the environment and Russia's war in Ukraine. That's an uncertainty for consumers, which are wondering what is going to happen with energy prices and with the future. There is an uncertainty on the investor side on wondering what is happening in the medium term. And these headwinds are going to stay with Europe for the time being. So that is the direct impact we are seeing, that the Russia's war on Ukraine has still implications for Europe's economic developments. On your second point with regard to the growth in Ukraine, growth numbers this year have been brutally affected by the bombing of the energy infrastructure in Ukraine, and that dampens growth and also the outlook. And in addition, of course, like for all of Europe, this creates uncertainty in Ukraine, and that has a dampening effect on aggregate demand. And when you're looking at our projections for 2025, we also have downgraded those for Ukraine, and that is a reflection that Russia's war in Ukraine is going to continue. We had assumed that it would stop earlier. It doesn't, and those are again additional costs for the Ukrainian economy. On Ukraine, the economic team has been doing and is still doing a marvelous job in terms of, one, maintaining macro stability, two, supporting the economy to get growth going and supporting enterprises to operate this environment, protect vulnerable people suffering from the war, and three, preparing the fundamentals for hopefully a reconstruction that will come soon, and the medium-term path to EU accession.
Thanks so much, Alfred. We're going to go with the lady on the third row, please.
Thank you. My question is related with Spain. Well, this is Paula Escalada with Agencia EFE. Spain has one of the best growth prospects in Europe. What recommendations do you have to ensure that this good momentum continues when the European funds end? And I would also like to know if you have any advice for the housing problem that the country is facing, which has provoked numerous protests by citizens who cannot buy a house due to speculation and high prices. Thank you.
Spain had indeed a very strong growth performance that was a result of what we saw on the tourism front, very much still to some extent the pandemic implication. Spain finally we saw also, because of lower interest rates and more confidence, a pickup in investment that has been supporting growth. And when we are looking at the supply side, we see the large employment increases have been supported also by immigration. So those were growth drivers we saw in Spain. They will moderate a bit in 2025, but they still will carry on. And of course, implementation of the next generation EU will not only have short-term positive impacts, but also impacts on the medium-term growth projections for Spain. I think when it comes to our policy recommendation for Spain, when you're looking at the growth performance right now, it was labor intensive, so it was driven by an increase in employment. In future, what we need to see is a growth performance which is driven by increase in productivity. And when I mention the word productivity, and you ask me a question on any country in Europe, that's the key word. Productivity is an issue in every single member country in Europe, and that needs to be the focus of strong policy reforms. Those are reforms domestically, and the structural reforms we have been talking about, our Article 4s. But importantly, these are reforms which need to be carried out EU-wide in order to get the productivity increases we need from the single market, from companies, firms be able to grow to scale go to the global technology frontier and produce, and to see a very dynamic business sector. That's an issue for Spain, but this is an issue for all other countries, and Europe can help there. This is not national action per se, but this is action at the European level. But it requires will at the national level to go for European reforms.
Thanks so much. We're going to go to the middle of the room, the lady in the third row, please.
Hello, Mehreen Khan from the Times of London. Two questions, if I may, on different topics. You mentioned the importance of integrating Europe's capital markets. In this context, how important is it for Europe to have bigger banks? Would you welcome the potential merger of UniCredit and Commerzbank? And if capital markets are very important, should the German government drop its objection to this potential bank tie-up? Have you also communicated a message to the German government? And on a completely different topic, you've warned about the need for advanced economies to carry out fiscal consolidation and to reduce their borrowing after many years of emergency spending. The UK Chancellor Rachel Reeves today has said that she will change her measure of, her debt target to one which promotes investment. Would you welcome this kind of step given your worries about the fiscal overhangs from the pandemic? Thank you.
Yeah, maybe I start with your first question on the Capital Markets Union and the Banking Union. Critically important for Europe. When we see drilling down why we have that productivity gap, one is companies cannot grow to scale. The second problem is lack of business dynamism. And lack of business dynamism stands for we have startups in Europe as we have in the US, but they are not getting the same kind of chance in terms of funding. Because as a startup, you need equity financing, especially when you're in the tech sector and you produce intangibles. You cannot provide that as collateral to banks. You need venture capital. And when you're looking at venture capital, Europe versus the US, it's 4 times as high in the US than it's in Europe. So startups in Europe start with a big handicap. And therefore, the Banking Union and the Capital Markets Union are essentially for those startups to grow and be productive, create employment, and push up GDP per capita. And yes, as part of the operating to scale for European economies, that they're not just national players in 27 national countries, but pan-European players, as the US companies are. You need also larger pan-European banks, and that means we see that one way of doing this is through merger and consolidations. So this is part of helping creating scale in the banking system, and therefore these mergers are welcome. And yes, that has been our recommendation that these mergers should take place. Now on individual merger transactions we are not commenting, but our advice is very clear that the general direction is clear. Mergers are needed.
Thanks. Yeah.
On the UK again?
Sure, and thanks. Would have been disappointed if there had been no question on the UK. Always popular. Let's start with some good news. So you have seen that our growth numbers for this year went up 1.1% instead of 0.7. Next year at 1.5. So that's the trajectory upward looking against which we discuss fiscal policy. So if you allow me, stepping back before coming to the fiscal framework and the debt question, we recognize that the government very helpfully is committed to reduce the debt level in % of GDP over the next 5 years, or at least to stabilize it. So that's very welcome. It's in line with long-standing recommendations from our UK team. Now, this is going to require a notable fiscal effort. As you know, the deficit levels are high. There are spending pressures waiting to be tackled in the healthcare system, social care. We also have very high public investment needs. There's transport, there's housing, there's climate. So all of this needs to be put under within one umbrella going forward. The team has always maintained that this can be done in different ways, including prioritizing spending or increasing fiscal revenue.
top banner headline of the Wall Street Journal. The U.S. economy extends growth streak. The next president inherits, this is the headline, quote, a remarkable economy. Let me just read you the first two paragraphs. Whoever wins the White House next week will take office with no shortage of challenges, but at least one huge asset, an economy that is putting its peers to shame. With another solid performance in the third quarter, the U.S. has grown 2.7% over the past year. It is outrunning every other major developed economy, not to mention its own historical growth rate. And Willie, the Wall Street Journal concludes, this is not happening by magic. It's not happening because of government intervention. It's happening because American people and American businesses are more productive today than ever before.
Yeah, absolutely. It's the front page, as you said, of the Wall Street Journal. U.S. economy extends growth streak, growth 2.8%, pushing up against that 3% number. We'll get an inflation number today and then that jobs number tomorrow, all just days ahead of the election. And that doesn't even count in, Joe, the mothers and the fathers fighting each other in the halls of Toys R Us, trying to get that Steve Ratner Cabbage Patch. Ugly scenes, frankly, but it's where we are as a nation.
They're so cute. I love them.
No, fist fights in the aisles. Let's go right to Steve Ratner, joining us with charts breaking down the surging American economy. Is former Treasury official, Morning Joe economic analyst, and matinee idol Steve Ratner. Steve, good morning. It's great to see you. So let's dive right into your charts. U.S. economic growth, as we just pointed out, leading the world. We've heard this, by the way, from economist after economist, Republicans even conceding, many of them, that at this moment, the American economy is, in fact, the envy of the world.
Well, Willie, first of all, I have to say I've been called a lot of things in my life. Matinee idol is a new one. I'm going to put that up on my blackboard at home. And,
you're like Leif Garrett.
Yes, yeah. I'm so flattered. And Cabbage Patch dolls, you know, those are the ones that cause the economy of up 2.8%.
There you go.
But anyway, let's put this in a little historical perspective. And we're going to compare the U.S. to the other major economies of the world. And you go back to 1980, you can see the growth rates weren't all that different. But around the 2000 period, we just took off. And we left them in the dust. We've continued to leave them in the dust. And in fact, the IMF last week came out with new projections that show that our growth is going to accelerate even more relative to these other countries. And let me also, though, since we are going to have an election next week, do a scorecard here on the last two presidents. Donald Trump thinks this economy is in the toilet. In fact, under Joe Biden, it grew faster than it did under Donald Trump. 3.1% average GDP growth under Biden. 2.8% under Trump, and this corrects for all the COVID things. These are straight down the middle of the fairway numbers. And then you can see that that growth, in fact, has turned into a much stronger economic performance for average Americans. GDP per capita is a way to think about standard of living. Not perfect measure, but it's directionally right. You can see that we generate $74,000 of GDP per person, and that has doubled over this period of time. And then you can, and no other country has come close to that, 54,000, 54,000, 46,000. And so from 1983 to 2023, we doubled this. And we are, again, as you said earlier, the envy of the world when it comes to the standard of living that Americans have.
And Steve, there's something for everything in your charts, including billionaires who really need to take note. For some reason, they think Trump's the answer, which is laughable. But there's also something here in your next chart for hardworking Americans looking for a break because they're dealing with inflation. Inflation numbers and unemployment numbers, how are they looking?
Yeah, look, we had inflation. Nobody can escape that fact. But let's put that in perspective as well, because our inflation was, in fact, less than inflation that occurred in the EU and in the United Kingdom. We didn't go nearly as far up as they did, and we've all come back down now, and our inflation is just around the Fed's 2% target, and also in line with other countries, and so our inflation has become well controlled. But because of our strong growth, we have a much different unemployment picture than the EU has. We have 3.7%, had 3.7% average unemployment in 2023, not that far off of the UK. But look at the UK at 6.7%. If you're looking for a job, would you rather be looking for a job in the United States? Would you rather be looking for a job in Europe?
And then your last chart, Steve, is looking at what's fueling the U.S. economy.
Yeah, a good part of what accounts for all that growth that I showed you a little while ago is the enormous investment that's been coming into the U.S. the U.S. is considered the most attractive country, major country in the world to invest in. And you can see, again, that our investment pace kind of tracked the EU well ahead of the UK and Japan, but tracked the EU for a long time. And then we took off and went in our own direction. And again, the projections show that we're going to continue to outstrip Europe and the rest of the world in terms of investment growth. And let's do the scorecard here. Biden, 9.4% average annual investment growth over his term. Trump, 3.9%. So when Trump says he's the president that brings back investment, brings back jobs, he's wrong. It was the things that were passed in the Biden administration, the Inflation Reduction Act, the bipartisan infrastructure bill, and the CHIPS Act, 3 major pieces of legislation that brought investment back. And that has all made the stock market very happy, as you know. The stock market has roughly up 51% under Biden, up 44% under Trump, and is, again, way outstripped other countries. And so business may say that they have concerns about Joe Biden or Kamala Harris, but in fact, under their administration, they did better as stock market investors than they did under Trump.
All right. Morning Joe economic analyst Steve Ratner, thank you very much for bringing us the report.
You're not going to believe this. 12,000 jobs added. 12,000, wow. Maria. We were looking for 113,000. We haven't seen this number since December of 2020, Maria. 12,000 jobs. Now, the range, I want to be clear, was 0 to 200,000. So economists were all over the place, but 12,000, well off of the estimate.
Cheryl, it has to be the hurricane. It has to be the hurricane, Cheryl.
Yes, ma'am. Yes, ma'am. There's 2 things that Charles, we were talking about, hurricanes and also the strikes that are happening right now. This could absolutely impact it. Let me give you the rest of the numbers and let y'all discuss this. 4.1% is the rate. 4.1%. That came in as expected. Private sector jobs, negative 28,000. Negative. Okay, we were looking for 90,000 added, negative 28,000 on private. Factory jobs, a loss of 46,000 jobs. Government jobs, we added 40,000 government jobs. We were just talking about that. There you go. That was 31,000 last month, I believe. Average hourly earnings, 0.4% to the upside. We were looking for 0.3% there, and then 4%, which is in line year over year for average hourly earnings. Labor force participation rate, 62.6%. But there is the layout, guys. I'm going to see really quick here. I got to get into the report, and I got to look and see if they're going to mention the hurricane. Okay. All right. So let's talk about this. Jobs trended higher in healthcare and government. Thank you. I know. Temporary help services lost jobs. Employment jobs were lost due to strike activity. That is in the report. I don't see a mention of the hurricanes yet, but I got to believe that's a piece of this, Maria. I'm sending it back to you.
Yeah, thank you. We are looking at a market that is trading up, I assume, Charles Payne, because they think this very weak non-farm payrolls number of 12,000 jobs created is going to move the Fed to continue to cut rates.
Yeah, and the first thing you want to look at is the 10-year yield, because that's been the canary in the coal mine squawking loud and loud and loud since that rate cut. It's rocketed higher. It was up slightly before this number. I think it's pulling back just a little bit. To your point, the market wants to see some relief there. But, one thing I will say, and I said when we started this segment, Maria, the consensus had to factor in. Everyone who adds the numbers to the consensus also factored in what they thought their hurricane impact would be. Right. So, you can't say, and again, the range, Goldman Sachs said it would be 50,000. Waller and the Fed said it could be 100,000. But those are factored in already. This is the unmitigated disaster that was probably going to happen sooner rather than later. And I think a lot of folks have touched on it on this panel. It's a red flag going into next year. A lot of these areas have been unsustainable. This government spending, by the way, remarkable. They still found a way to do over 40,000 jobs. That's going to come to an end as well.
Yep. What do you think, Julia, in terms of these numbers? What would you say is behind such a weak jobs number for the month of October?
I don't think this should be a surprise, and it's not just the effect of strikes and storms. The other issue here is weak seasonal hiring. So October is usually a month in which we add 1 million jobs to the economy due to seasonal employment in retail and transportation and warehousing. The JOLTS report that came earlier this week showed very low numbers of openings for September. For September, this was the lowest retail job opening number since 2011. And transportation and warehousing also very low. And we're seeing a pretty slow start to this holiday hiring season at ZipRecruiter in online job postings as well.
Steve, how do you see things?
I was just looking, Maria, and you may have to verify this. I'm just looking at the numbers myself, and Cheryl may have to verify this, but it looks like there was also another big downward revision. Did I get that right?
Yep, down 31,000 for September.
Yeah. So we just keep seeing this pattern. I gotta say, there are heart palpitations right now at the White House in the Kamala Harris campaign. I mean, this is the worst possible news they could get 4 days before an election. You were just talking to Charles about this kind of media circus about how great the economy is. A piece in the Wall Street Journal, the economy is great, and then these numbers come out. One other quick thing. That point that was made a little bit earlier about people not quitting their jobs, that's a really important indicator on how people feel about the labor market, because when people hold on to their jobs, they're very worried about whether they can find a new job. And when you get a report like this, now you know why they're worried.
Yeah, that's true. John Lonsky.
Yeah, I think that lower quit rate tells us that this 4% year-over-year increase by the average wage is perhaps going to slow fairly soon. This is, the lower quit rate suggests that employers are under less pressure to keep increasing wages to hold on to valued employees. Nevertheless, some will voice concern that this 4% annual increase by the average wage will block further progress at reducing price inflation, especially in labor-intensive service industries.
Yeah, we got the downward revision in September. Cheryl, you've got other revisions as well.
So, yeah, August revision is 81,000.
81, yeah.
81,000. So if you combine, and Maria, you mentioned the 31,000 for September. So if you combine that, that's 112,000 fewer jobs that were added between August and September, yes.
Okay, so you got another 112,000 fewer jobs.
Correct.
So these revisions are not doing anything for this storyline that everything's so great, Charles.
Yeah, it's, the headline writers at some of these media outlets, listen, they'll find a way to write this off and say it was hurricane related and all that kind of stuff. But again, I think it's insulting to the American public that are living these numbers. We talk about these numbers and it sometimes dehumanizes the whole thing. These are people who are becoming hopeless in America, particularly young Americans who have given up on the American dream. And instead of dancing around it, we need to find out. And again, I think a lot of this goes back to this notion of pumping in a bunch of money, building a big government, and then bragging about nominal gains such as GDP when it hurts the most people. And one thing you mentioned earlier, Maria, and I just thought about it. This inflation story is not gone. The media keeps talking about inflation as if it's gone, that it's yesterday's story. And I every time we use a chart on inflation, we should use the cumulative CPI number, because that's the only number that matters right now to the average American, and it just goes higher and higher and higher at a slower rate, but higher and higher and higher.
Yeah, and Cheryl, the inflation is where specifically? I know you've talked so much about food and shelter being two major issues, but walk us through where you see the biggest issues for the American people right now, because you're talking about the essentials, Cheryl, right? I mean, this is what? Food, energy, and shelter.
Gas, groceries, and also eating out at restaurants. Restaurant prices, from a food perspective, have also jumped higher across the country, and that also affects American families and the psyche as we go into, obviously, an election on Tuesday. But, egg prices are up 160% under the Biden-Harris administration. I mean, eggs is such a big staple of the American diet, and the kitchen. Ground beef prices are up 30% under this administration. Bread has jumped 24% under this administration. Cereal 22%. Produce 14.5%.
Hey, Maria, one other one is housing, mortgage payments. You know how much those are up? 90.
ये दुनिया भर में घूमते भटकते लाइफ एंजॉय करते हुए बिजनेस बिल्ड नहीं होता. Let me
97% over the last 4 years. In other words, the average monthly mortgage payment on a new home has almost doubled in terms of what you have to pay. No wonder we have a situation where young people can't afford to buy a home. It's twice as expensive.
Joel, you see a number like this, you see a market reaction like this. Dow Industrials up 153, had been up higher than 170 on this idea that, well, the Federal Reserve's going to have to move if this is the kind of economic story we're talking about. What do you want to do as an investor? Where are you seeing the flows right now?
Well, I'm still bullish for the remainder of this year. We've got 2 months. Usually the fourth quarter ends on a strong note. Despite the job numbers, and by the way, there were no major surprises in this. The government increased. The biggest increase was government. We're seeing manufacturing jobs decline. But we are seeing, some companies, particularly the larger tech companies, performing well. Amazon came out yesterday, had really strong results. And so we're seeing pockets of growth in this area. So I'm still bullish in the last 2 months of this year in terms of the markets. Now, to that point, the markets being high probably also contributed to the job reduction because we're seeing more and more more and more retirements. Got 4.3 million eligible people per year who are eligible for retirement. When the markets are high, as we saw, peaking in periods right before the COVID, kicked into high gear. A lot of people retired when the markets were high. We're seeing that probably again. I think the markets are going to end this year on a strong note. I think the interest rates, to Charles' point, the long bond, the 10-year, is down about 3 bips pre-market. It was up 3 basis points. And so that's going to be encouraging to the point that people are going to think, okay, we're going to get at least 2 rate cuts. I don't see it going 50 basis points in either month. But that seems like it's now solidifying when there may have been some concern in the last week or so.
Well, I'll tell you right now, Tom Lee at Fundstrat is talking about what Mark Newton, his technician, has said, and that is that the market internals have deteriorated. And Mark Newton has been talking about these internals like volatility and futures market and inverted, yield curve. He says all these market internals have deteriorated, and they were expecting some, rockiness and volatility in the month of October. I'm just wondering what happens now in a new month and into December once we have more clarity on the election. Because, Charles, you know that the election has also been a factor. We know we're not going to know on the night of November 5th. Yeah. Like, why not?
That's a tough one. That really is a tough one. In the age of AI, in the age of instant knowledge and information, that we're really bracing for an election. And the longer it drags out, the longer it takes for us to know, the greater the pushback, right, in terms of this being a contested election. But I do want to say one thing about, the labor force in of itself and these earnings. Think about what Google said this week. 25% of their code was written by AI. Wow. Technology, Challenger and Gray and Christmas, technology by far, they have the most layoff announcements. So yeah, ironically, the tech stocks probably will regain and have regained leadership in part because they're able to shed workers. And at some point, so will other companies in this country because of AI. And that's a factor that I don't know anyone can model for 2025, but it's growing every single day.
Well, Julia, you must be dealing with that on the jobs front as well. Technology replacing humans in many areas.
So the big question now is how can GDP be growing at a steady or even accelerating rate while employment growth is slowing? We have a situation where GDP is actually above the pre-pandemic trend, whereas employment is below the pre-pandemic trend by about 5 million. Now the answer is productivity growth, which has been tracking about 2.5% and is very high, is unusually high. Now that's, Charles Payne was talking about the disconnect between economists and workers and ordinary Americans. And, economists think of productivity growth as fantastic. It's the silver bullet that allows non-inflationary growth. But at the same time, it means if you're an entry-level worker, you might find a hard time getting jobs. More of you competing over fewer opportunities. It's great for very high-tech workers, very skilled workers with AI skills. But elsewhere in tech, employment is very, very sluggish. It hasn't grown in almost 2 years.
And that's what we're seeing right here this morning for the October non-farm payrolls at 12,000 jobs created in the month of October versus an estimate of better than 100,000. The Bureau of Labor Statistics says this: it is not possible to quantify the effect of storms on payrolls. Cheryl told us it was the storms as well as other issues here. The strikes is what you said, Cheryl. I want to get your take in terms of what that looks like for December. I mean, these strikes were in place in November. The Boeing strike is still on. They're trying to put a new deal in front of machinists right now, right?
Right. No, and that they're not going to vote until Monday, day before the election. So we'll see what the machinists do when they go back. You know, their union leaders have told them there's probably a very small chance you're ever going to get your pensions back, and that's the sticking point at this point, to be honest, between the two sides. So, you know, we'll see what happens on Monday. But no, absolutely. You know, and I was looking for more commentary on the storms, and it really does seem to be, in particular, they say flat out with the manufacturing losses of 46,000, that mostly was because of the strike at Boeing. They flat out say it in the report. So at least we've got some clarity on that.
Well, I mean, Charles, this is one of those days when bad news for American citizens is actually becoming good news for investors, because they see this as a chance for the Fed to keep cutting rates. Dow Industrial's up 200 right now.
Jay Powell is breathing a sigh of relief. Now, it does go to the fact, though, that the Fed, they do have and know and have access to things. And by the way, you know, the general public, again, with the headlines, things are fantastic, things are great. You've got to go through these. You've got to look at everything. I don't think this month is going to be the anomaly, even with the strikes and even with the hurricanes. I think we've learned today that September, that big number in September was the anomaly, and it's going to get whittled down more and more as we go on, and that magnificent number will be less magnificent. And the fact is now the long-term trend is extremely spooky for Americans out there looking for a job.
Well, look at rates falling like a rock this morning. The 10-year Treasury yield is down 5.25 basis points, Charles, and the 2-year is down almost 9 basis points. What about this? I mean, John Lonsky, this has gone in the complete opposite direction that people were expecting. When the Fed started talking about rate cuts, rates actually went up, and with this data this morning, they're plummeting.
Yeah, I think that's good news, you know, for these potential first-time home buyers. At least this latest rise by mortgage yields might come to a halt, but still mortgage yields are going to be a lot higher than we thought what would be the case when the Fed cut rates back on September 18th. And, you know, let's not, you know, forget about the fact that one of the reasons why bond yields took off, why they ascended, was because of these massive federal budget deficits. It's $1.8 trillion that the government is spending in excess of what it's taking in terms of tax revenues. And you have to get this deficit under control. You've got to get government spending under control if you are going to have any hope of ultimately taming inflation and bringing borrowing costs down to levels that would make housing affordable again.
How do you see it, Steve Moore?
Well, you know, when you factor in these job revisions, which were down over the last 2 months by roughly 110,000, what it should say on the screen, it says 12K jobs added in October. That's true, but what this means is that we have 100,000 fewer jobs than we thought we had. That's a really bad number. When you're looking at a situation, to add to what John Lonsky was talking about, where we are running nearly $2 trillion deficits, and the government is the fastest growing sector of our economy, we've got something structurally really wrong with this economy. We cannot continue down this path. There is no plan out of the Kamala Harris plan. I've looked at her plan. There's no plan to cut government spending. They keep adding more and more workers, and I'm sorry, we're growing the economy in all the wrong places. And by the way, I'd love to hear what the numbers were for construction, manufacturing, business services, the things where people actually make things in the economy, because those are not growing at all. This is the worst jobs number we've had, Maria, in 3 years.
Cheryl, what do you say?
Well, I was looking into, Maria, what you mentioned earlier about the storm impact on the report. I don't have the construction number in front of me, but there's a huge note at the bottom of the report. I don't know if Steve has seen it yet, but it talks about the specific timing of the landfall of Hurricane Helene, which was September 26th, and then the fact that it tracked north into all these other states. And it says this was before the October reference periods for the household and the establishment surveys, but then it goes on to talk about Milton and how that struck October 9th during the reference period for these surveys. So basically what they're saying is, look, there is an impact on that, but because of the way the data was collected and possible disruptions, we may not get more clarity on that until the next report. Maybe they'll do an update between now and then.
Economic data this morning.
The U.S. economy added only 12,000 jobs in October. That is significantly less than expected. The unemployment rate held steady at 4.1%.
We are so lucky that we've got our economic dream team here to tell us more about these numbers and what it means for you. We've got NBC News business and data correspondent Brian Chung and Investopedia's editor-in-chief Caleb Silver. Thank goodness that graphic was the bobble one. I appreciate that control room. Brian, let's start with you. Walk us through these numbers and how it varies from previous months.
Yeah, good morning, guys. A real disappointing jobs report that we got here. Let me just walk you through some of the numbers. As you mentioned, 12,000 jobs added in the month of October. That was well below estimates. Actually, economists were expecting something like 100,000 jobs in the month. Instead, what we got was something around here, just 12,000 jobs added. I do want to point out that there were a number of things that impacted this jobs report, which explains why it's so low. First off, you have the two hurricanes Helene and also Milton. And then you also have the Boeing strike, where over 40,000 workers in the Pacific Northwest went on strike during that period, actually still remain on strike, as you heard from Tom Costello. But one important thing to point out here is, despite those things, the unemployment rate did stay the same. It's at 4.1% right now. But again, that headline number of just 12,000 jobs added in the month, certainly pretty disappointing.
All right, so Caleb, Brian mentioned the hurricanes there. Does that mean this is a blip, or is this saying something larger about the state of our economy right now, especially as we head into the election?
Yeah, I think of it as a blip, because if you think about the average for the past 12 months, we've added 194,000 jobs a month on average. There were big revisions down for August, 81,000 jobs, down September, 31,000 jobs fewer, but still 194,000 jobs a month. The unemployment rate is key. These are two different surveys, but if you look across the other numbers, the amount of long-term unemployed, the people that can't find work, they're almost exactly the same as they were last month, which is similar to the month before. So this has got to be because of the strikes and because of those two hurricanes.
And Brian, break this down by sector for us. Where are we seeing the biggest changes?
Yeah, well, again, because the headline number was so low, a lot of